Welcome to this explainer. Today, we're acting as data detectives. We're going to take Blackstone's dense financial metrics and transform them into a really clear story of price versus intrinsic value. If you look at the landscape of alternative asset managers, Blackstone is just an absolute titan. But recently, their stock chart has been telling a kind of complicated story, full of these contrasting signals. So today, we aren't just looking at stock prices. We're going to literally dissect the underlying anatomy of their valuation. Using the detailed data we've got today, we'll figure out exactly what the market is pricing in right now and see if there's maybe a massive opportunity hiding right in plain sight. Okay, let's just quickly run through our agenda. First, the Blackstone data mystery. Second, analyzing the valuation multiples. Third, profitability and performance engine. Fourth, the dividend cash profile. And finally, our final verdict on BX. All right, let's dive right in. Starting with Section 1, the Blackstone data mystery, looking specifically at price versus fair value. Boom, negative 21.91%. This massive number represents Blackstone's year-to-date return. And man, it's an immediate red flag that just grabs your attention, right? I mean, a drop of nearly 22% in a single year for a premier financial institution. That's a huge deal. For anyone who really follows the markets, a steep decline like this immediately forces you to ask, wait, is this a fundamental breakdown of the business model, or is this simply a case of broader market sentiment dragging down a really high-quality asset? To answer that, we've got to look past the ticker price and evaluate the actual intrinsic worth. Now, check out this dramatic contrast between the current, frankly, beaten-down price and the discounted cash flow fair value estimate. On the left, we see the last close sitting at roughly $118, $117.89 to be exact. But look on the right. Based on discounted cash flow metrics from our source data, the fair value price sits way up there at almost $150, $149.70. This gap? This is the exact mystery we're here to solve today. The market is pricing Blackstone at a really steep discount to the actual cash it's projected to generate. So we have to wonder, is the market just being overly pessimistic right now, or are these fair value estimates maybe a bit too optimistic? Moving right along to Section 2, analyzing the valuation multiples. What exactly is the market paying right now? This perfectly illustrates how Blackstone's current multiples are trading significantly below their own 3-year historical averages. Just look at that top row. The current price-to-earnings ratio is 30.15. Now, in a vacuum, sure, that might sound a little high, but look right next to it. The 3-year average is an incredibly lofty 48.20. That means, compared to its own recent past, Blackstone is trading at roughly a 37% discount on an earnings basis. And we see the exact same story playing out with the price-to-sales ratio. It's sitting at 9.79 today, compared to a historical 14.62. Even the PEG ratio, which actually factors in growth, is lower today at 1.70 than its 3-year average. Across the board, it's super clear. Investors right now are just unwilling to pay the premium they were happily paying just a few short years ago. So the really crucial point here is that analysts are actually projecting some strong forward-looking optimism. While the trailing PE, which is based on past earnings, is 30.15, take a look at the forward PE estimate, sitting over in the crystal ball at a much more attractive 20.24. So what does that actually tell us? Well, it tells us that earnings are expected to grow pretty significantly over the next 12 months. Think about it. If the stock price stays exactly where it is today, the valuation actually becomes way cheaper as those anticipated earnings finally materialize. All right, Section 3, Profitability and Performance Engine. Let's look under the hood of BX. A cheap valuation only matters if the underlying business is actually operating effectively. And this chart shows how a practically pristine 100% gross margin efficiently filters down to a very solid 20.56% net profit margin over the trailing 12 months. Now, because of the nature of asset management, gross margins often appear practically perfect, right? Because their top-line revenues are essentially just fees collected. But the true test of any firm's operational efficiency is what they actually get to keep after all the expenses, taxes, and overhead. Generating over 20 cents of pure profit for every single dollar of revenue brought in, that proves Blackstone's operational engine remains remarkably robust, even in what's been a pretty tough year for their stock price. Furthermore, look at this stellar return on equity, over 36%. This really highlights how highly efficient the management team is at generating returns from shareholder equity. The current ROE is actually higher than its trailing 12-month and 3-year averages, which, let me tell you, is a fantastic sign of fundamental strength. On top of that, the return on invested capital sits at an impressive 17.45%. This basically proves that for every dollar of capital Blackstone deploys out into the world, they are generating substantial, real value. This right here, this is the absolute hallmark of an elite compounder.
Moving on to Section 4, the dividend cash profile. How are they rewarding shareholders?
For a lot of investors, a stock like Blackstone isn't just about capital appreciation, it's a serious income vehicle. Here we see a really attractive yield approaching 4% that has grown aggressively, boasting a 3-year compound annual growth rate of over 12%. That is some exceptional income growth, but look closely at that last bullet point. That massive 121.52% payout ratio immediately jumps right off the screen as a huge potential concern. I mean, a payout ratio over 100% literally means the company is paying out more in dividends than it's officially recording in net income.
So this data point begs an incredibly important question. With a payout ratio of 121.52%, is this dividend actually sustainable long-term? If you only looked at the standard payout ratio, you might honestly start to panic. You might assume, wow, Blackstone is taking on debt or draining its reserves just to keep dividend investors happy, which would be a massive red flag for any of us analyzing a stock. But as we know in finance, we always have to dig one layer deeper to find the real truth. And the answer lies in the cash. Check this out. The much lower free cash flow payout ratio of 82.14% indicates that the dividend is actually well covered by real cash generated, not just accounting earnings. You see, net income includes a whole bunch of non-cash accounting deductions that can artificially drag down the bottom line. But dividends? Those are paid out of cold, hard cash. Blackstone generated over $4.5 billion in free cash flow over the trailing 12 months. So when we measure the dividend against that actual cash, the payout ratio drops down to a much safer 82%. Phew, right? The dividend is fully covered by the cash the business is actually producing. Finally, Section 5, final verdict on BX. It's time to balance short-term pain with long-term gain. Bringing it all together, let's weigh the historical context against the current valuation to form our final verdict. We've seen a beaten-down price, solid operational metrics, and a safe, growing yield. Now we got to look at the timeline. This perfectly visualizes the stark contrast between the painful recent short-term price drops and the massive compounding long-term returns. If you just zoom in on the past year, yeah, it looks pretty bleak. Down 8.6% in 30 days, down almost 17% over the trailing 12 months. But look what happens when you zoom out. Over 5 years, the total return is nearly 60%. Over 10 years, an astonishing 610%. Blackstone has historically been an absolute wealth-generating machine for patient investors who can stomach a little short-term volatility. Which brings us right back to this crucial number, the estimated 21.25% margin of safety, based on those discounted cash flow metrics we talked about earlier. Basically, this means that even if Blackstone's future growth ends up being a bit slower than projected, you still have a 21% cushion built right into the current stock price before you're technically overpaying for its intrinsic value. You're getting the chance to buy a highly profitable, historically dominant firm at a notable discount to its calculated worth and its historical multiples. Ultimately, after completely examining the anatomy of this valuation, the final decision really just comes down to what you believe these metrics are signaling for Blackstone's future. The data we've unpacked today shows a company with robust margins, highly efficient returns on capital, and a safe 4% yield, all currently trading at a 21% margin of safety just because of a tough year in the markets. So I'll leave you with this final thought. Based on the data, does the recent 22% drop scare you away, or does it signal the absolute perfect entry point for a long-term compounder? Thanks so much for joining me on this explainer, and remember, keep letting the data guide your learning.